Today's episode is sponsored by Saxo, the platform bringing you a premium investment experience without the premium price tag. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Mean reversion is one of the most powerful forces in financial markets. When returns, valuation, or concentration rise to extreme levels, it's usually only a matter of time before they come back into line with history.
I want to know which aspects of markets are subject to mean reversion and how long we might have to wait. And in today's dumb question of the week, if you love mean reversion so much, why do you hate technical analysis? All right, let's get into it. So this week we're going to talk about mean reversion. Now, when you look at financial markets, there's all sorts of different indicators you can look at, and arguably some of them will mean revert over the long term, as in if a value gets too far above or too far below its historic average, you can kind of expect it to come back into line. But other things don't mean revert. So how do we tell the difference between these two things?
Well, there are theoretical reasons why some things will mean revert, and other things just tend to mean revert because it makes sense. But I think the things which are physically constrained, so for example, if a company's earnings grow faster than GDP forever, it'll become the economy, and that can't happen. So there are constraints on what can and can't grow at certain levels relative to other things. GDP is one example. There are all sorts of other constraints, such as population growth, whereas other things just come back to some kind of reasonable average, and that's more to do with psychology. And then there's a third category of things which can carry on trending forever. So they can carry on increasing, things like stock prices. So whenever you see a headline which says things like, oh, the market's reached an all-time high, well, so what? That could happen repeatedly forever. But if you hear that valuations are at 60 times forward earnings, well, that's a very different story.
So maybe let's start with valuations, because that is something that we both agree should be mean reverting. And they are at high levels when you look compared to history, especially in the US.
Yeah, I mean, it's not crazy levels. So as we record this, the forward price to earnings multiple for the S&P is 21.4. Now, that is high relative to history. It has been higher, so it might have reached something like 30 times in the past, but it has reached lows of 8 after the global financial crisis. So those are the kind of ranges you'd expect, really extreme ranges. But typically, it would be around 16 times, maybe 18 times.
I mean, that's one question, isn't it? When we're talking about reverting to the mean, how do you determine the mean? It's the long-term average, right? But how long is long-term? So I see in your fantastic PensionCraft tools, when I click on S&P 500 forward price to earnings ratio, the 60-year average is 15 times forward earnings, and the 10-year average is 17 times, and the 5-year average is 19.4 times. So that would say to me that stock prices have been toppy for a while in the US. But which of these should we be looking at?
I think if you're going to look at some kind of reverting trend, then there is a case to be made that people are willing to pay more for stocks than they were in the past in terms of the profits that they generate. And this is why it's a little bit of a moving target if you look at the mean reversion for price to earnings multiples, because there is no theoretical value which is fair. It could be 20 times, 30 times. However, if you look over the last 5 years, you can see that that average is quite a long way below where we are today. So I think it would be difficult to argue that over the last 5 years, there's been a psychological shift in humans, which means they're willing to pay more for US stocks. So long term, 15 times, shorter term, something like 18 or 19 times. But whatever you choose at the moment, you can see that the valuations do look stretched.
So to give some context, to get back to the 60-year average for the S&P 500, that would be a 30% fall from where we are today. Whereas to get back to the 10-year average, it's a 20% fall. And to get back to the 5-year average, it's almost a 10% fall. It's quite neat, actually, 30, 20 or 10, right? The numbers make for a good headline right now.
And this is why people ask me always, should I drip feed or should I simply put all of my money in today if they've got a lump sum? And at the moment, I'm still saying, well, I'd probably drip feed, because when you do have these stretch valuations, I think there's a higher chance that something will happen and people will suddenly come to their senses and realize they've overpaid.
I mean, the thing with valuation when it comes to stocks and this forward price to earnings multiple is it's not just random, isn't it? It's not purely sentiment and narrative.
Well, one way to look at it, and this isn't a great way, but it does give you a rough idea, is to compare it with the return on a risk-free investment, where risk-free would be something like a money market fund, for example. Now, the current risk-free rate is around 5% in the UK. And if you look at the current earnings yield, the forward earnings yield, which is when you take the price to earnings multiple and flip it, if the price to earnings multiple is 21.4, 1 over 21.4 is 4.7%. So that's another way to look at it. Think about the earnings you generate for the investment you make today. And for stocks, hopefully, they should be generating a little bit more than you'd get with something which is risk-free. Whereas that's not true at the moment. So you could be thinking, well, if I put $1 into a money market fund, I could earn about 5%. If I put it into stocks, I'm currently earning, 4.7%.
And you said that's not a great way to look at it. Why is it not a great way to look at it?
Well, it doesn't incorporate things like capital growth. And also, it's called the Fed model, but I just think it's not useful because it's not very predictive. So in that sense, it doesn't really help you much. But valuations are not predictive, not strongly predictive over the short term. So I think that's why people dismiss it. But I think it's useful as a gauge of whether things are expensive or cheap.
So when you look at the multiples at the moment in the US, and they're above the 5-year, above the 10-year, way above the 60-year, do you look at that and say, well, at some point, it will go back to the 60-year average in the next big crash that happens for whatever crisis comes along?
Yeah, that could happen, or it could just be something less scary. It could be just that earnings start to grow more quickly and then prices just take a breather. So instead of a huge shock to the system, it could just be a period when markets trade sideways. That has happened many times in the past. You get 5 years when there's no real movement. So that would be a less pernicious outcome and a less painful way to get back to reasonable valuations.
But you're confident that it will mean revert. It won't stay at above 20 times forever.
I don't think so. And I think the reason why is that people lose interest. That's just human nature. Something else comes along and they just think, well, that's more interesting. Whether it's house prices, cryptocurrency, whatever.
Interest rates.
Yeah, interest rates.
Interest rates get interesting.
Which they have. And I think that's why eventually people lose the euphoria narrative, whatever it is. At the moment it's AI, it'll move on to something else.
I also think that the forward price to earnings multiple doesn't capture a lot of things. Like, for one, it doesn't capture the risk-free rate and interest rates. If rates are low, stocks look relatively better value than if they're high. And it also doesn't incorporate the expected earnings growth over, say, the next 10 years. Like, it's just looking at the next 12 months. If there's a paradigm shift because of AI or whatever, if it really does boost productivity and economic growth and corporate profits, then maybe stocks will do better than is suggested by the forward price to earnings ratio.
Yeah, it's not set in stone by any means. It's just that given the forecast profits today, and we can only look forward a short period of time, then, the prices that we're paying today are pretty unreasonable. And that crystal ball, the forward bit, is based on broker forecasts who are, let's face it, optimists. They always try and think that things are going to be great in future. So usually this is a fairly conservative valuation measure that usually makes stocks look cheap.
I have seen some arguments for why valuation multiples might be higher going forward than they have been, let's say, over the last 50 years. The one people often state is the rise of passive investing, and more people joining the market has pushed so much money into stocks that will support valuations. Like, where else are you going to be over the long term? And people have come to realize that and are not going to panic and sell just because there's bad news. Maybe. We'll see. The other thing I hear is that the economy has tilted so much in favor of corporates that they are able to deliver much higher profit margins than in the past. And that does seem to be true, at least in the US, where profit margins are elevated, which should be good for stocks.
Yeah, I think both of those are partial arguments for why valuation should be higher. But then the question is how much higher, and will it stay high if the narrative changes. At the moment, I think it's still the case that we're in pretty much a euphoric bubble where everybody thinks markets only go up. They can't remember a time when markets crashed for a significant period of time. And that means that people are willing to jump back in when markets fall. But eventually, I think there will come a point at which people lose interest. It's just human nature. You just look at the news cycle. People only remember what happened 24 hours ago.
And when people make that point about profit margins being higher, I start to wonder, well, maybe profit margins will be mean reverting. So if you look at the average for the S&P over the last 30 years, the operating profit margin is around 8.5%, whereas we've been above that for much of the last decade and are currently at around 11.5%.
But if you think about what it would take to shift those margins back down, I think workers in the US would have to unionize again. And I don't think there's political support for that, certainly not at the moment, not in America. So I think the pendulum's probably going to stay stuck there for a while. However, if there was a political shift in the US, and I've got to say the political shift at the moment is moving the other way, then yeah, maybe margins would fall again. But I can't see that happening in the near future.
The only path to it I can see is increased antitrust action, which does seem to be targeting some of the highest margin companies in the economy, namely the big tech companies. But we'll see whether that really goes in and puts downward pressure on margins, or even at the extreme starts breaking up those companies. And when we talk about big tech, another thing that is particularly out of line with history right now is the concentration in the market. If you look at the weighting in the S&P 500 of the largest 10 stocks, it's around 32% right now, which is significantly above any time since the 70s.
Yeah, that is unusual for the US, although it must be said that the US is less concentrated than other markets. So, for example, in Switzerland, the 10 largest stocks make up almost 3/4 of the stock market. In Korea, 60%. In Taiwan, 58%. In Germany, 57%. But what is kind of odd is that the US has so many stocks, and yet you do get this huge dominance by this small group of stocks, and that is unusual for the US. And then you'd have to go back to the 1970s, the early 1970s, to have such high concentration. But will it mean revert? I think it probably will. And the reason for that is always the narrative changing and something else becomes popular, and then there's a change in the leadership of the market cap table. Antitrust, I think, as you said, that's another reason why it might happen. We're already seeing that. And of course, competition is just the case that new companies come to the same market, if it's a very profitable one, and push those companies off their perch.
And a more normal concentration for the top 10 stocks would be something like 20 to 25% of the index. So there would be a reasonable way to fall. Or not necessarily fall. Like you said earlier, things can resolve themselves for good or bad reasons. Like it could be that the mega cap stocks have an average decade, whereas the rest of the index has a great decade. Who knows?
And I think that is the way it might happen. It could be the fact that you just get lackluster growth from the large caps, the mega caps, and the other companies catch up, which would make sense because they're undervalued, many of those mid-cap and small-cap stocks in the US right now, because they're just not sexy. They're not seen as something which is worthwhile investing in.
There's kind of three groups which we could argue are potentially undervalued, at least compared to the mega caps. You've got the other large caps, so everything else in the S&P 500, the S&P 490. Then you've got the S&P 400, which is the mid caps. And then you've got the S&P 600, which is the small caps. And relative to the S&P 500, the small caps look more undervalued than at any point I can see in recent history, at least. I think you'd have to go back to 2000 and the height of the dot-com bubble to briefly see a period where small caps were so undervalued on a forward price to earnings basis compared to the S&P 500.
Now, if you're a hedge fund, what you could do is go market neutral and go long small caps and then short large caps so that overall you're insensitive to market movements. But if the two converge, then you make a profit. If they diverge, you make a loss. So that would be one way to play it if you're not long only as we are. But the way I've approached it is simply to buy a US small cap index fund.
So you really are betting on mean reversion here in the spread between small cap valuations and large caps. Does it need a catalyst for that to happen, or will it just happen naturally, do you think?
I don't know what the cause will be. I don't know what the trigger will be. but it's something that will happen. It's just a matter of being patient and waiting for it to happen. Unfortunately, by being long only, it could be the case that the whole market tanks and then you get a slight recovery, which is greater for small caps than mega caps. So that might be the way it reverts. I'm hoping that it simply means that small caps are going to outperform, but that's just wishful thinking on my part, of course.
I think it's quite likely that small caps will do relatively better just because of the valuation spread. But I'm not as convinced that there will be full mean reversion. I think you could make the case that something in the economy has changed, especially when it comes to the internet and the data economy and now AI. You do need that huge scale, and maybe that's where the profits are going to come from. It's so capital intensive to build these data centers, and it does look to me to be quite winner take all, which is why all these big tech companies are throwing so much money at the moment. They know that they need to be the ones that win this. And I'm going to make a controversial point here,
Okay.
which is that I think the small cap premium, which we've seen over history, that over the long term, small caps on average have tended to slightly outperform large caps. I think that might be dead.
Ooh, that is controversial. I like that. I'm not sure it's true.
You've got to make a controversial claim. It's certainly been dead since the financial crisis, but I don't see it coming back anytime soon. Not to say there won't be years or even decades where it does a bit better, but I wouldn't put all my money in small caps.
I mean, if it was something like energy companies dominating the large cap table, then yeah, it's very difficult for a small cap to become a global energy producer. Whereas if you're a startup ideas company, I think you've got a greater ability to scale nowadays than you did in the past. So I'd say there's a greater breakthrough probability for a small cap to make its way up the league table of market cap than there was in the past. So I'd say that innovation is still going to come from small caps.
You know what? I think you might be right there. And an example of that is OpenAI, where it has blitz scaled and been the fastest growing product in history, I think. But it's a private company while it's doing that, partly owned by the mega caps. And I think that's what we'd see. There'll be venture capital backed and they won't be accessible to public markets until they've already had that hyper growth phase.
Yeah, maybe. I think it's true that many small caps are staying private for longer, but it's still the case that companies want an out. You know, they want to get rid of the stuff that's on their books, and they're probably going to miss some of the good ones. And those will carry on scaling once they've left the gentle embrace of private equity and then move to public markets. So I still think there's another bite of the apple for those companies.
Maybe. But when you look at the small cap indices, they tend to have a large weighting to things like regional banks and consumer discretionary companies. It's generally not tech. It's not going to be these things which come to dominate the world, I would argue.
Yeah, that's certainly true.
But I guess you only need one needle in there, maybe, to make it worthwhile.
But, you know, there could be financials, which are essentially tech companies, or consumer discretionary, which is essentially a tech company like Amazon, which could be really innovative and exciting. So I wouldn't rule out that source of innovation. I think it's, if anything, a more level playing field today than it was 30 years ago. Today's episode is sponsored by Saxo, the platform bringing you a premium investment experience without the premium price tag. As all good investors know, nobody can control what happens in the markets, but one thing they can control is their costs. That's why Saxo has lowered their prices so you can grow your wealth and more of your money stays right where it belongs, with you. Search Saxo, invest for less.
The other factor in stock markets that seems to be particularly out of line with history is the relative performance and valuation of growth stocks versus value stocks. So for much of history, I think it's true that value stocks were the ones that delivered greater long-term returns, whereas, as we know, since the financial crisis, it's been growth stocks, particularly those massive growth stocks in the US. And still today, the forward price to earnings ratio for growth versus value reflects that, where growth stocks in the S&P 500 have a multiple of 27.1 and value stocks have a multiple of 16.7.
Yeah, that dispersion is large. And the last time when it was quite as large, if not larger, was in 2000, during the dot-com bubble.
It was even larger then, yeah.
Yeah, so it was 40 times for growth at that time and roughly 15 times for value. So the dispersion was even larger. But guess what happened then?
It's interesting when you look at the graph over the last 30 years, is that the multiple for value stocks doesn't change that much. It bounces around between 12 and 18, whereas the valuation for growth stocks goes way up and down, up to like 40 in the dot-com bubble, down to 10. Like it matched the valuation of value stocks during the global financial crisis.
I think that's the euphoria aspect. The place where it is felt is usually in the growth stock space. It's hard to get excited about value stocks.
So it's hard to see this dispersion mean reverting for any reason other than a crash in growth stocks. Like, how could you have value stocks rallying to meet them when the valuation never really gets ahead of itself?
Although, if you look at year-to-date returns over the course of this year, 2024, and this is up to September, value stocks have been doing pretty well. And if you look at mega caps, they've been underperforming. So that is a kind of rotation to value, if you like, although it's a kind of slow one. And that's the thing. People don't really notice it because it is boring.
I guess returns could mean revert in that way. But in terms of valuation multiples, they probably couldn't revert in that way. It would take growth stocks being taken down a peg or two.
Yeah, to be fair, there is usually that grey bar that appears when the two lines converge, growth and value valuations. And that grey bar is a US recession. And at the moment, we're just not seeing a recession in the US. So the narrative continues and the euphoria continues.
And there is euphoria in the US stock market, I think. Certainly its share of global markets is elevated compared to history.
Yeah, and speaking to people one-to-one, I always see a US overweight. So you see they've got a global index, and then alongside that, they've got a US index. And I often say to them, look, you know, you've got 60% US already. All you're doing is increasing the concentration further. But the reason why is because of the huge outperformance of the US relative to other countries over the last, 2 decades? However, that's why I'd be nervous, because I think it will mean revert. A more normal US share of market cap might be around 50%, but it's been bobbing along around 50% since 1930, if you look back in time. Sometimes a bit less, sometimes a bit more, but at the moment it's pushing the upper boundary of where it's been in the past.
Are you sure this is something that will mean revert, though? To me, this seems like something that might not, for a few reasons, one of which is that foreign stocks often list in the US now. So is the US stock market really just a reflection of the US? And also countries are growing at different rates. The regulations around markets are changing in different countries all the time. And companies are selling around the world all the time. Is the US market just US companies?
No, and I think you're right. Other companies are choosing from other countries to list in the US because of the deep capital markets. So there is a kind of attraction to the US because success breeds success. However, I think there are certain factors which would stop that happening. Particularly individual countries will not want their companies migrating to the US, and they may actually stop them or offer really juicy incentives in order to stay in your domestic stock market, which we're already seeing that in the UK, for example, although arguably it's not working.
I mean, it's definitely not working. How many companies have we seen go and list in New York now?
But what we forget is that the US has accidents. And when those accidents happen, suddenly all of the shine comes off that market. And the kind of accidents we've had in the past have been an energy crisis in the 70s. We had the dot-com bubble. We had the global financial crisis where financial engineering kind of scuppered markets. So I think these accidents do affect the US and they make it less shiny and exciting for a period of time. And then the pendulum swings back. And these are unpredictable accidents. So you can't really say, oh, I know what it's going to be this time. It's going to be some kind of accounting scandal at a big tech company. Oh, I've said it.
Everyone's rushing out to place their shorts.
That's right. But I think it will happen. And I think, that's usually what's been the trigger in the past.
Can I be devil's advocate? Because you said at the start, there are some things which mean revert because there are fundamental reasons for it. And there are some things that mean revert because of sentiment and an attachment to history. I don't think there's a fundamental reason here. There would be if the stock market was just related to the domestic economy, but that's long not been the case. Like, there's no reason, theoretically, if the world was getting along with each other. Why you couldn't have every stock listed in New York, right? It could happen in theory.
But that's a good example, I think, that example you give, which is that if everyone was friends with the US, that'd be fine. But half the world isn't. So I think those countries will want a pool of capital from their domestic investors and their allies, which don't include the US. And while that remains the case, then those countries will have their own stock markets and try to stop their stocks listing on those US markets. China, for example, would be one case, and a very large case where that's true.
I mean, it is certainly the case at the moment that the US is significantly richer valued than other global stock markets. So if you compare the valuation multiples, as we said, the US is around 21.4 right now. The world ex-US is around 13.4. So a lot lower.
And just imagine if we fast forward 100 years and try to imagine what the world will look like. If you look at a global market cap weighted index where it kind of shades in the countries which are included in the index, there are huge swathes of the world where there's almost no weighting at all. Places like Africa, which have potentially huge populations, potentially huge growth, potentially huge capital markets, but which simply don't exist in the market cap weightings at all. And when they come online, then I think the dominance that we see in the US currently will inevitably be pushed into the sidelines because the US population simply isn't that large. And ultimately, if you do look at mean reversion, a really long-term mean reversion, it's population that matters. The US is very good at generating profits, GDP growth, and yet if you look at where GDP growth is coming from today, it's not the US, it's emerging markets. And I think ultimately it might be places like Africa, depending on what happens to populations. So that's ultimately, I think, the death knell for the US and its market cap weighting, which is other countries will come online and it'll just matter less.
But what if people in Africa buy iPhones and drink Coca-Cola like everyone else?
But that's the point, I think, which is that innovation will start coming from Africa and not from the US, because there isn't something inherently less productive or innovative about African people. It's just that at the moment, given the political situation, given their economic development, it's very difficult to become an iPhone producer in Africa. And we're already seeing innovations start to come from China. If you look at things like innovative technologies, they're starting to produce the innovative stuff, and the West doesn't like it. But that's the way the world's going to be in the future. A lot of the innovation will come from beyond the shores of the US and Europe. But that's just, a kind of long-term view, I think. It'll take many years to get there.
You might be right, Robin, but what you're arguing for there is not really mean reversion, like things just getting back into line because they should. You're arguing for a new trend.
I'd say it's just a new equilibrium point, because if Africa becomes highly productive and innovative and its market cap grows, then the weighting for the US just won't make sense.
There'll be a lot of waiting to get Africa to surpass the US right now.
I don't think it's going to happen in my lifetime, put it that way, yeah. But countries like India, there you could see, and you already are seeing, a huge growth in their capital market relative to China, say. But those two countries, China and India, I think will be much more dominant in the future than they are now.
I mean, just to go back to the US, there is one very famous indicator, which some people claim should mean revert. And this was coined by Warren Buffett. It's called the Buffett indicator. And that's the ratio of the total US stock market to the US economy. So stock market cap versus US GDP. And if we go back through history, let's go back into the 70s. That was around 50% for most of the 70s, as in the stock market was worth roughly half of the size of the US economy. In the dot-com bubble, it rose to almost 150% before falling back to almost 50% in the global financial crisis. And since then, it's been on a steady upward drift and is now at around 200%. So the stock market is twice the size of the US's annual economic output.
Now, you could argue that the US exports to the rest of the world, so using domestic GDP isn't an appropriate measure. And one of the things I did for an explainer for our members was to look at it relative to global GDP. But there also what you're starting to see is that the US is hugely outsized relative to its historic weighting. So US market cap to global GDP is very close to all-time highs. So I think that is one that probably should mean revert, because we can't have a situation where the stock market is the economy. That just would make no sense.
It seems to me that most of what we've talked about here, whether that's the relatively higher valuation for US stocks or the high concentration in the US market compared to history, or the small cap underperformance or the value underperformance, or just the dominance of the US generally, all of those things kind of have the same driver underneath, which is the emergence of a new industry over the last decade or so around the internet and now AI, and the fact that that's been captured by just literally a handful of companies.
True, and I think that is the driver. And historically, when that's happened in the past, then other companies have come and started to steal their dinner, as it were, by capturing market share. It happened with the bicycle bubble, the canal craze, the railway bubble, and then you get this period of brutal consolidation as new winners come to the fore. So I think there's nothing to stop companies in China, but also elsewhere, copying this model and stealing some of the market share. And I think ultimately that's going to take some of the wind out of the sails for these companies.
For all of this stuff to not mean revert, or at least not fully mean revert, a lot of things would have to go right for those companies. They'd have to stay dominant in the industries they currently control, allowing them to maintain profit margins. They'd have to probably capture new industries along the way and stop competitors growing up to eat their lunch.
And that would be a tall order. It's never been managed before, and I doubt it'll be managed this time either. I don't want to seem too negative. It just seems to me that that seems too optimistic, too much of a Pollyanna-ish view of US tech companies.
But if you looked at your portfolio and my portfolio, you wouldn't see that view reflected. Like, we don't have the courage of our convictions to tilt away from global market cap weighting.
No, only in my fund portfolio do I try and tilt away. And there it's fairly small size, because I'm not convinced that it's going to happen anytime soon.
And I'm not convinced it's going to happen, but we'll see.
Now, one of the things Michael mentioned was our tools that we offer for our premium website members. So if you want to try those out to look at mean reversion and what it means for your portfolio, you can learn more on our website. Just go to pensioncraft.com/membership.
Okay, today's dumb question of the week is, Romin, if you love mean reversion so much, why do you hate technical analysis? Isn't this whole thing based on mean reversion?
Yes, kind of. But it's just lots of squiggly lines on a graph. It doesn't really necessarily deal with mean reversion. Sometimes it does, sometimes it doesn't. But it's what you use it for. I think that's the big difference. The point that technical analysts make is that you can do tactical trades to make money out of their signals. And I'd argue that that's not true. Things like price to earnings multiples can stay high or low for long periods of time. So they give you very little information about when the things are going to revert. Whereas if you look at how they sell technical analysis, it's not only sold as something which gives you the direction, but it also supposedly gives you the timing.
So in its most simple form, technical analysis might look at a stock, track its stock price alongside the 200-day moving average. That's a very simple example. And it'll say, if the stock goes above the 200-day moving average, then it's overbought and you should sell. And conversely, if it drops, you might want to buy it. And it's not really to do with valuation. It's just to do with kind of tracking the momentum of a stock in that instance. But it is kind of mean reverting to a trend, I guess.
Yeah, you look at things like crossing of the 200-day versus a shorter term average, and that's supposed to signal a turnaround in a stock. And it can work to some extent because momentum, as we know, is a factor that works in markets. So yeah, maybe it would work some of the time, but I think if you rely on it, it's just a very unreliable signal. Many professional traders do rely on it, but many professional traders lose money. So I think it's not the case that it's a panacea and it's giving you infallible signals, far from it. And at worst, it's sold as something which is misleading, which makes people have some kind of comfort in a signal which simply is not reliable.
It's one of those things where I don't believe in technical analysis. Like you said earlier, it's just drawing lines on a graph and trying to read stuff off it. It's kind of like astrology for trading bros. But so many people look at technical analysis that maybe it has some influence and therefore there's a signal there just because people pay attention to these moving averages and Bollinger Bands and everything else.
Yeah, I mean, you could argue that if people believe enough astrological predictions in the newspapers, then it'll change their behaviour and it'll become self-fulfilling and astrology will work. However, I'd argue that not enough people are that gullible, and ultimately it's fundamentals that matter. Because if you look at a stock and if it's got really awful profits, well, that's not going to do very well, even if the technical signals are telling you that it should turn around. So I don't really buy the argument that fundamentals don't matter and that technical analysis does. I think that's too extreme. But could it work in some cases? Yeah, I think it's possible, but I just would never rely on it.
It seems to me that over the past few years, people have got distracted by one of two extremes. On the very short-term extreme, you've got technical analysis, which is not looking at the fundamentals of a stock. And on the other extreme, you've got this kind of macroeconomic analysis where everyone obsesses over what the Fed's going to do and trades on that basis, which again is not looking at profitability of companies really, or their growth or anything like that. I'd like a situation where we all return to look at companies' balance sheets and their earnings, and that is what's going to drive stock returns.
Yeah, I agree. In a just world, that's what people would look at. But I think ultimately it's going to be things like technical analysis that provide the noise in markets. And it is tempting to look at these patterns and read too much into them. It's just the way we are as humans. We see patterns where they don't really exist. If you show people random numbers, they'll see a pattern in them because our brains are just designed to find patterns in data. But if you look at some proponents of technical analysis, they'll claim that you can use it for all sorts of things. FX markets, for example, which are inherently unpredictable, and people will lose a lot of money following this kind of snake oil analysis, which I find really disturbing. And I think that's the kind of really worrying end of technical analysis, where it does lead people astray and suggests that you can make money when really I doubt you can.
People make loads of money from it selling courses. I always wonder why anyone's buying a course for something like technical analysis and trading, because if that person was really good at it, they wouldn't be making a course, would they? They'd be selling it to a hedge fund for like £1 billion.
But what if you tell people to buy index funds, Michael? Surely you couldn't make a business out of that.
You can make a very successful small cap. Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.